Throughout human history, war has demanded a brutal sacrifice not just in blood, but in capital. When a nation goes to war, it typically raises taxes, cuts domestic spending, or issues war bonds to cover the massive costs. It essentially asks its citizens to directly pay the price for the conflict. That was the established economic norm. But in 2003, the United States rewrote the rules of financial gravity in a way the world had never seen. For the first time in modern history, a global superpower fought a major, protracted conflict entirely on a credit card. Welcome back to Unfiltered Finance. Today, we are stripping away the political rhetoric to examine the raw, objective balance sheet of the 2003 Iraq War. We are looking at a historical masterclass in massive capital misallocation, the undeniable birth of modern deficit addiction that plagues the current economy, and how the financial shockwaves of this specific event planted the very first seeds of global de-dollarization. To understand the sheer magnitude of this financial fallout, we must first look at the anomaly of 2003. According to data from the Congressional Budget Office, instead of raising taxes to fund the mobilization, the US government actually went the opposite direction and implemented massive tax cuts in 2001 and 2003. The predictable mathematical outcome was devastating to the national ledger. Federal revenues plummeted. And this drop in income happened precisely at the same time that military expenditures skyrocketed into the trillions. How does a nation spend trillions without taxing its citizens? It borrows. The US Treasury issued an unprecedented volume of debt, effectively transferring the cost of the conflict to future generations. But here is the most ruthless law of finance. Compound interest never sleeps. The initial estimates for the war were famously pegged at around $50 to $60 billion, a rounding error for the US economy. However, according to the Comprehensive Costs of War project at Brown University, the direct macroeconomic cost is closer to $3 trillion. But that is just the principle. Because the conflict was entirely debt-financed, the United States has been paying interest on that borrowed money for over 2 decades. By 2050, the interest payments alone on the debt incurred for the Iraq and Afghan wars are projected to reach an estimated $6.5 trillion. This is the illusion of deficit spending. The geopolitical objective is immediate, but the financial bleeding is generational. Furthermore, war is not a static expense that ends when the troops come home. In macroeconomic terms, it is a massive, long-tail liability that haunts the national ledger for decades. Research from Professor Linda Bilmes at the Harvard Kennedy School highlights a sobering reality regarding the astronomical costs of medical care and disability compensation for veterans. Historically, the financial peak of these obligations occurs 30 to 40 years after a conflict officially ends. This brings us to the ultimate and most ruthless economic concept: opportunity cost. Every single dollar is subject to this law. You can only spend it once. Trillions of dollars were rapidly absorbed by military logistics, overseas bases, and relentless interest payments, which meant those were trillions of dollars explicitly not invested in upgrading domestic infrastructure. They were not invested in pushing the boundaries of technological research and development. And they were utterly missing from the foundational investments in the education system. We witnessed a bizarre global dynamic. While the United States was literally pouring its capital into the sands of the Middle East, other competing nations were aggressively funneling their resources into building robust, modern industrial bases. What occurred wasn't just spending. It was a systemic and massive wealth transfer. It shifted the future liabilities of everyday taxpayers directly into the immediate, highly profitable balance sheets of private defense and energy contractors. But the most profound financial consequence of 2003 did not happen inside the United States. It happened thousands of miles away in the quiet, sterile boardrooms of foreign central banks. To understand this, we must look at the global financial architecture of the early 2000s. At the time, the US dollar's status as the undisputed global reserve currency was completely unquestioned. Foreign nations, particularly manufacturing powerhouses in Asia, held massive trade surpluses. They eagerly took those surpluses and bought US Treasury bonds. This mechanism effectively lent America the cheap capital it needed to fund its growing deficits. It was a perfect symbiotic loop. The world produced goods, the US consumed them, and the world bought US debt. However, the sheer scale of the unilateral debt-funded spending in 2003 sent a silent tremor through this system. Foreign creditors watched as the US bypassed traditional fiscal discipline, choosing the printing press over taxation. These creditor nations began to quietly analyze a terrifying systemic risk. What happens to our national savings if the custodian of the world's reserve currency abandons fiscal responsibility? Because when a central bank prints massive amounts of money to fund structural, unending deficits, it doesn't just devalue the money at home. It effectively exports that inflation to the rest of the world. And nobody likes paying the hidden tax of inflation for a war they aren't even fighting. This historical inflection point marked the conceptual birth of a movement we now call de-dollarization. Before 2003, holding US Treasuries was considered the ultimate risk-free asset, the bedrock of global finance. After 2003, sophisticated sovereign wealth funds and central banks began to view it very differently. They realized that holding these assets now carried a hidden, unpredictable geopolitical risk premium. Though Saddam Hussein's highly publicized attempt to sell oil in euros in the year 2000 was largely viewed as a symbolic political stunt by global markets at the time, the macroeconomic aftermath of the 2003 invasion proved a terrifying point to emerging markets globally. International financial systems could be unilaterally weaponized against sovereign nations, and relentless, unbacked deficit spending could fundamentally debase the core value of the global reserve asset. This realization was the catalyst. It is why, in the years immediately following the conflict, we saw the very first strategic, calculated moves by massive sovereign entities like China and Russia. They began to slowly and methodically diversify their foreign exchange reserves away from a US dollar monopoly. They started to aggressively accumulate physical gold as a neutral, uncancelable store of value. And they began drawing up the complex blueprints for alternative financial settlement architectures, systems designed specifically to bypass the traditional, dollar-dominated global banking hub. Which brings us to the ultimate reality check for today's market. As geopolitical tensions boil over between the US and Iran, we must view the current conflict through the lens of the 2003 balance sheet. Here at Unfiltered Finance, we don't deal in political predictions. We deal in math. In 2003, the US debt-to-GDP ratio was roughly 60%. The federal funds rate was being slashed, and the balance sheet had immense elasticity. The US had the financial padding to absorb a multi-trillion-dollar shock. Today, the environment is fundamentally different. The US debt-to-GDP ratio hovers around 120%. Annual interest payments on the national debt have crossed the $1 trillion mark, surpassing the core defense budget itself. A major escalation with Iran today would not be financed in a vacuum of low rates and strong fiscal health. It would occur in an era of sticky inflation and exhausted bond markets, and highly skeptical foreign creditors. The elasticity is gone. So, what does this mean for the everyday investor watching the global news today? The 2003 Iraq War proved a very dangerous modern macroeconomic thesis. It proved that you can indeed put a massive multi-year geopolitical conflict entirely on a national credit card. But you can never, ever outrun the mathematical certainty of the final bill. It fundamentally shifted wealth from the public ledger directly into the hands of private entities. It silently eroded vital domestic investments in favor of endless, debt-funded overseas expenditures. And most importantly, It quietly cracked the foundation of the US dollar's unquestioned global supremacy. When we look at the escalating tensions between the US and Iran right now, the mainstream financial media tends to focus strictly on the short-term, sensational metrics. They panic over the price of crude oil spiking tomorrow morning, or the immediate supply chain disruptions passing through the Strait of Hormuz. But if macroeconomic history is our guide, these are just the surface ripples. The true financial risk of a prolonged Middle Eastern conflict in today's environment is the sheer inability of the current, exhausted fiscal system to absorb it. The systemic risk is a catastrophic, uncontainable break in the global bond market. To conclude, the financial autopsy of the 2003 conflict leaves us with a stark, undeniable reality. It definitively proved that while geopolitical objectives can initially be financed through massive debt, it triggers an irreversible wealth transfer that slowly erodes domestic economic stability. Furthermore, it quietly but permanently cracked the foundation of the US dollar's unquestioned global supremacy. Today, as tensions escalate in the Middle East, we face a highly leveraged system with zero elasticity. If macroeconomic history is any guide, the true danger isn't a temporary spike in the price of crude oil tomorrow. The ultimate threat is a systemic, cascading failure within the global sovereign bond market over the next decade. In an era of sticky inflation and skeptical creditors, the illusion of consequence-free deficit spending is finally over. Investors must look past the daily political noise and recognize the raw mathematical realities of global debt. Because when the bill inevitably comes due, the market will not care about political rhetoric. It will only care about liquidity. Thank you for joining this analytical deep dive here on Unfiltered Finance. We rely on rigorous data, such as the comprehensive research from Brown University and the Harvard Kennedy School. If you value objective, data-driven market analysis without the sensationalist noise, make sure to subscribe and join our community of rational investors. Protect your capital, stay rational, and we will see you in the next market cycle.